You saw the headline about the Japanese premium on silver, but the real story wasn't in the numbers. It was in the mechanics of a system disintegrating in real time, silently, while most still believe markets function. The 80% premium isn't volatility, it's institutional panic. When Tokyo pays $130 per ounce and New York trades at 71, you're not seeing supply and demand. You're seeing the fracture of a pricing system that existed for decades. The COMEX isn't a silver market. It's a paper casino where banks sell contracts representing metal that doesn't exist. For years, this illusion worked because nobody asked for physical delivery. But something changed. Someone started asking for the real metal. Japan isn't paying premium on a whim. It's paying because its refineries, its semiconductor industries, its solar panel manufacturers need real silver atoms, not electronic promises, not futures contracts, physical metal that can be weighed, melted, and transformed. While everyone slept, global industrial demand for silver surpassed mining production, not for one quarter, for consecutive years. The structural deficit isn't macroeconomic theory, it's geometry. More metal leaving inventories than entering month after month until inventories evaporate. The banks that sold short trillions in silver contracts now face an existential problem. They bet they could roll positions indefinitely, cash settling any naive client who asked for delivery. But the Japanese aren't asking for cash, they're asking for physical bars. And there aren't enough bars. The arbitrage between Tokyo and New York should be impossible. Traders should buy at COMEX for 71, transport to Japan, and sell at 130. Guaranteed profit of 83%. But nobody's doing it, because there's no metal available to arbitrage. Silently, registered inventories at COMEX fell to levels not seen since the 80s. Bars eligible for delivery represent less than 3 days of global industrial demand. A pricing system built on leverage of 100 to 1 is being tested for the first time in decades, and it's failing. The old model worked like this. Miners extracted silver, banks bought and stored. Futures markets created artificial liquidity through paper contracts. Pricing was centralized, controlled, predictable. Wall Street dictated global price through COMEX. The world accepted. The new model is different. Industrialized Asia decided it won't accept paper as metal substitute anymore. China, India, Japan are buying physical directly from miners, refiners, and recyclers. They're bypassing New York. They're creating their own pricing centers based on real metal, not synthetic contracts. Behind the scenes, banks are in survival mode. They can't close sold positions without causing catastrophic short squeeze. Can't deliver metal they don't possess. Can't roll contracts indefinitely while physical premium explodes. They're trapped in a prison of their own making. The mechanics are brutal. Each contract that expires at COMEX forces the bank to choose. Deliver physical bars they don't have or cash settle and admit the contract was fiction. Every time they choose to settle, confidence in the system decreases. Every time confidence decreases, more participants demand physical delivery. The Japanese premium isn't temporary anomaly. It's signal of permanent decoupling between paper markets and physical markets. For decades, we assumed these two markets were the same thing. Now we're discovering they were only connected by confidence, and confidence is evaporating. Silver isn't just precious metal, it's critical industrial input. It's in solar panels, electric vehicle batteries, semiconductor chips, medical equipment, water purification systems. The global energy transition depends on silver, and there's no viable substitute for most of these applications. While everyone looked at Bitcoin and gold, silver became the silent bottleneck of global electrification. Each solar panel uses about 20 grams. Each electric vehicle uses between 15 and 30 grams. China plans to install 1,000 gigawatts of solar energy by 2030. Do the math. The numbers don't add up. Miners can't respond. Silver is byproduct of copper, lead, and zinc mining in 70% of cases. You don't open pure silver mines because prices never justified it. Increasing silver production means increasing base metal production, but base metals have their own supply and demand cycles. The time between discovering a deposit and producing commercial metal is 7 to 10 years. Even if current prices justified new projects, metal would only reach market next decade. But demand is growing now. Electrification is happening now. The deficit is widening now. Central banks can't print silver. Governments can't legislate new mineral deposits. Silver obeys laws of geology, not laws of monetary policy. And geology is saying there isn't enough metal to feed global energy ambitions at current prices. The fracture between Tokyo and New York is just the beginning. Soon we'll see similar premiums in Shanghai, Mumbai, Singapore. Each regional physical market decoupling from Wall Street's synthetic pricing. Each creating its own equilibrium based on real supply and demand, not high-frequency trading algorithms. Western investors still treat silver as speculative commodity. They buy ETFs, futures contracts, bank certificates, paper promising silver exposure without the inconvenience of storing physical bars. But paper only matters if there's metal behind it, and increasingly there isn't. Asia understood this earlier. Culturally, they always preferred tangible assets: physical gold, physical silver, real estate. For decades, the West laughed at this preference as backward. Now, as physical inventories migrate east, that preference looks prophetic. The confrontation isn't just geographic, it's philosophical. West versus East, financial abstraction versus physical reality, leverage versus ownership, speed versus security. And the physical world is winning because, in the end, you can't build a solar panel with a futures contract. Silently, we're witnessing deglobalization of commodity markets. For 50 years, New York and London dictated global metal prices. That pricing monopoly is ending, not by political decision, but by physical necessity. Asian refineries can't wait for Wall Street to decide what their needed metal is worth. The implosion of bank shorts won't be a single event. It'll be a gradual and painful process. Some banks will exit positions through private arrangements. Others will be forced to close operations at catastrophic losses. Some may even challenge validity of contracts they never intended to honor with physical delivery. The precedent is dangerous. If COMEX loses credibility as pricing mechanism for silver, what happens to other futures markets? Gold, copper, oil? Global financial architecture depends on premise that futures contracts represent real assets. If that premise falls, entire systems need rethinking. Behind the scenes, conversations are happening between regulators, exchanges, and major banks. How to restore confidence. How to avoid run on physical inventories. How to maintain fiction that paper markets and physical markets are interchangeable. There are no easy answers, because the problem isn't liquidity, it's physics. Liquidity solves temporary supply and demand problems. You borrow money, wait for market to rebalance, pay loan back. But how do you borrow metal that doesn't exist? How do you defer delivery of critical inputs to factories operating just in time? Modern economy doesn't tolerate friction. There are no safety stocks. There's no margin for error. The Japanese premium is symptom of mismatch between world we built and resources available to maintain it. We promised energy transition without securing critical metals. We promised electrification without sufficient mining. We promised infinite growth on finite planet. Now the bill is arriving. Silver is just the first visible fracture. Lithium, cobalt, graphite, rare earths, copper are all facing similar structural deficits. The difference is silver has liquid futures market where mismatch manifests through explosive premiums. Other metals simply disappear from spot market without reliable reference price. While everyone slept, the world changed from abundance to scarcity, from buyers' markets to sellers' markets, from finance dictating reality to reality dictating finance. This inversion isn't temporary, it's structural, and it will redefine who has power in the 21st century. Power used to be in who controlled capital. Banks, funds, financial markets determined prices and allocated resources. But capital can't create atoms, can't transform sand into silicon, rock into metal, void into matter. Power is migrating to who controls physical resources: mines, refineries, transport routes, strategic stockpiles. Japan is paying $130 because it understands this new reality. Because its companies don't compete for financial returns. They compete for operational continuity. Stopping a semiconductor production line for lack of silver costs millions per hour. Paying 80% premium is irrelevant compared to cost of stopping. The banks sold short at COMEX still operate under old logic. Maximize quarterly profits, manage risk through statistical models, assume markets always rebalance. But physical markets don't rebalance instantly. New mining projects take a decade. Material substitution takes years of research. Some supply breaks are permanent. The trap is closing. Each passing day, more metal flows from west to east. More contracts expire demanding delivery. More physical premiums explode. More confidence evaporates. The pricing system built in the 70s is collapsing under its own weight, or rather, under absence of weight. Because the real metal simply isn't there. The question is no longer whether there will be reckoning. It's when and how. Forced liquidation of positions. COMEX rule changes allowing mandatory cash settlement. Government intervention to protect banks from catastrophic losses, total migration of pricing to Asian physical markets. All these options are on the table. None are painless. Historical precedent isn't comforting. Every time paper markets dramatically decoupled from physical markets, the result was crisis. Nickel in London last year, oil in 2008, gold in the 70s. History doesn't repeat, but it rhymes. And the current rhyme is getting louder, more urgent, more impossible to ignore. Silently, sophisticated investors are repositioning, moving from ETFs to allocated bars, moving from futures contracts to spot purchases, moving from paper promises to physical possession. They understood that in a world of scarcity, ownership is the only real hedge, not synthetic exposure, not statistical correlation, verifiable physical possession of real atoms. The irony is brutal. For decades, financial markets mocked those who stored physical metal as relics of the past. Why pay custody when you can have exposure through derivatives? Now those relics have the asset everyone wants, and the derivatives are revealing their true nature. bets on assets that may not exist. The system won't collapse all at once. It'll crack piece by piece. First silver, then other critical metals, then agricultural commodities. Each market discovering that excessive leverage and physical delivery don't coexist peacefully. That you can have infinite liquidity or delivery credibility, but not both simultaneously. The coming months will tell whether Wall Street can contain the fracture or whether the Japanese premium is just first of many decouplings. Whether COMEX can restore confidence or is destined to become irrelevant for global silver pricing. Whether banks can unwind positions orderly or will face existential margin calls. But one thing is already certain. The world changed. The era of abundant cheap metals ended. The era of paper dictating physical prices ended. The era of assuming resources will always be available at correct prices ended. We entered new era of scarcity, of premiums, of physical markets commanding paper markets. And in this new era, who has the metal makes the rules. Not who has the contract, not who has the algorithm, not who has the leverage, who has the bars, the tons, the real atoms that move the real economy. That's the future. And the future doesn't negotiate, doesn't accept promises, only accepts metal. The 80% premium isn't end of story. It's the beginning. The start of brutal realignment between expectations and reality, between finance and physics, between what we promised to build and what we actually have to build with. And each passing day without facing this reality makes the final adjustment more violent, more expensive, more inevitable. Capital has no feelings, only destinations. And capital's destination now flows to who controls atoms, not bytes. To who owns metal, not contracts. To who understood that, in the end, gravity beats leverage, always has, always will. Japan paying 130 while New York trades 71 isn't an anomaly. It's the new normal. It's how markets function when paper and reality divorce. And this divorce is just beginning. The next chapters will be even more revealing, even more brutal, even more definitive about who really understood the game.